Today, by Biden, Trickle Down Economics. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, I was impressed when Biden came out and said that trickle-down economics doesn't work. I've been saying that for quite some time. Of course, the idea is you put stimulation in the top and the big guys will get it, and eventually it trickles down to the bottom and the breadcrumbs are there for ordinary people. It doesn't work. It hasn't worked for a long time. It just made the rich richer, the poor poorer, and created a bigger disparity between the two. So the question really is, has Biden really consigned trickle-down economics to the dustbin of history? And it's really very interesting, of course, because the old adage was cut taxes on the rich and unleash a wave of entrepreneurship. Growth will pick up and more jobs will be created. Everybody benefits. That, in essence, is trickle down. And that's the theory of economics that Joe Biden wants to consign to the dustbin of history. Yay, I think he's right. The US president was a young politician when the idea that cutting taxes on the well-off would be good for the poor first came to vogue in the 1970s. Now he's used his first address in a joint session of Congress to call on the US top 1% to pay for his 1.8 trillion US American Families Plan. Higher spending in areas such as education, childcare and infrastructure. And anticipating the pushback from Republicans on Capitol Hill, Biden had a simple message. It was time, he said, to build the country from the middle and the bottom outwards, not from the top down. Trickle down has never worked, he said.
20 million Americans lost their job in the pandemic, working and middle-class Americans. At the same time, roughly 650 billionaires in America saw their net worth increase by more than $1 trillion in the same exact period. Let me say it again. 650 people increased their wealth by more than $1 trillion during this pandemic. And they're now worth more than $4 trillion. My fellow Americans, trickle down economics has never worked. And it's time to grow the economy from the bottom and the middle out. You know, there's a broad consensus of economists left, right, and center, and they agree what I'm proposing will help create millions of jobs and generate historic economic growth. These are among the highest values investments we can make as a nation. I've often said our greatest strength is the power of our example, not just the example of our power.
The post-war story of the US economy can be divided into two distinct periods. A period from the late 1940s to the middle of the 1970s when, as President John F. Kennedy said, a rising tide lifted all boats, and the trickle-down period ever since. In the former, the dividend from a growing economy was shared evenly among income groups. Those in the top 10% of earners grew richer at the same rate as those in the bottom 10% of earners. But since the 1970s, average incomes have flatlined once inflation has been taken into account, while most of the gains from growth has gone to those at the top. A recent paper by the economists Carter Price and Catherine Edwards fleshed out what that has come to mean in reality. They calculated that the incomes of the poorest 10% of Americans would be $2.7 trillion higher had income growth remained as equitable as in the years up until 1975. Cumulatively, the gains to those often struggling to get by on poverty wages would have amounted to $47 trillion between 1975 and 2018. Supporters of Trickle Down Economics say the low levels of pre-crisis unemployment, the US's record of growing faster than Europe, and the ability of the US to spawn giant world-beating companies all suggest that cutting taxes on the better off does pay off. Yet Biden and his supporters would argue that the real comparison is between the US before and after the mid-1970s. In the 1950s and 60s, not only was the world's biggest economy a less unequal country, it also grew faster. Investment was higher, and so were rates of growth of productivity. This was achieved with an income tax rate on the rich that peaked at 91% under a Republican president, Dwight Eisenhower. Biden needs an explanation for why he's reversing the strategy of his predecessor, Donald Trump, by putting up federal income tax to just under 40% for Americans earning more than $400,000 a year. He believes he has won. The end of trickle down will be good for ordinary Americans and good for the economy as well.
The jobs plan is going to create millions of good-paying jobs Americans can raise a family on. As my dad would then say, with a little breathing room. And all the investments in the American Job Plan will be guided by one principle: buy American. Buy American.
And subsequently, President Joe Biden told voters in an Atlanta suburb that his proposed tax increases on the wealthy would finance tax cuts for many more Americans, as he took to the road to sell his plans to build infrastructure and invest in education, childcare, and other priorities. This is a tax cut for more than 2 million families in Georgia, Biden said of his proposals during a drive-in rally in Gwinnett County, marking his first 100 days in office. It's about time the very wealthy and corporations started paying their fair share, he said. It's about time, it's simple as that.
Good guys and women on Wall Street, but Wall Street didn't build this country. The middle class built the country, and unions built the middle class. I think you should be able to become a billionaire and a millionaire, but pay your fair share. We're going to get rid of the loopholes, allow Americans to make more than $1 million a year and pay a lower tax rate on their capital gains than Americans who receive a paycheck. And the IRS is going to crack down on millionaires and billionaires who cheat on their taxes. We're going to reform corporate taxes so they pay their fair share. It's time for corporate America and the wealthiest 1% of Americans to just begin to pay their fair share.
Biden traveled to the state, which is a political battleground after major Democratic victories in November and January, following his first address to a joint session of Congress on Wednesday. In that speech, he unveiled his sweeping $1.8 trillion proposal that would expand education opportunities and childcare for families, financed in part by the largest tax increases on wealthy Americans in decades. Biden defended the proposal and a $2.25 trillion companion infrastructure plan that would be partially funded through higher corporate tax rates as a once-in-a-generation investment in America that would create millions of jobs. A 15% minimum book tax for US corporations, he said, would raise enough to pay for all of this. Biden was elected in part thanks to flipping Georgia to the Democratic column for the first time since 1992. Two Democrats, Raphael Warnock and John Ossoff, subsequently won a pair of runoff elections for the US Senate early this year, giving the party control of the chamber and allowing Biden to pass a $1.9 trillion relief measure without any Republican votes. Because of you, we passed one of the most consequential rescue bills in history, Biden told his audience. The White House said that more than 6.2 million adults in Georgia received stimulus checks thanks to the legislation, while the state received $8.6 billion in local and state fiscal relief. Biden had originally planned to hold his first rally in the state in March, but shootings in the Atlanta area that left 8 people dead, 6 of whom were Asian women, led him to put off the event. Now, it's true to say that President Joe Biden is likely to see some version of his $4 trillion economic plan passed in Congress by September or October, if, and it's only if, he can keep various demographic fractions from splintering the party and continue fending off Republican attempts to paint it as radical. Biden holds some advantages in pushing for what would be a massive expansion of the government, not the least of which is the trillions of dollars spent to counter the economic dislocation of the COVID-19 pandemic, reset expectations in Congress, and among voters about fiscal policy. Once Biden's plans is put into legislative text, Democrats can use Senate rules to bypass Republican opposition to most of it. The GOP, meanwhile, has struggled to make a focused attack on the Biden plan amid an internal power struggle between loyalists to former President Donald Trump and establishment Republicans aligned with Senate Minority Leader Mitch McConnell. But the president's proposals won't emerge from Congress unscathed, and it's not yet clear which parts will be left on the cutting room floor or what might be added. There is also the question of whether Congress, with Democrats holding only the narrowest margin of control, sticks to Biden's two-party vision of a roughly $2.3 trillion tranche focused on infrastructure and manufacturing and $1.8 trillion focused on education and childcare. The first test will be infrastructure. There is a strong possibility that Congress is able to come together on a smaller bipartisan measure focusing on roads, bridges, transit, water and broadband internet in the coming weeks. Republicans, led by West Virginian Senator Shelley Moore Capito, has made a $568 billion counteroffer. While much smaller than Biden's $2.3 trillion, more broadly defined infrastructure plan, it is nearly the size of the Obama-era stimulus bill, a sign of how much expectations have shifted. The White House and Biden spoke with Capito by phone on Thursday and may schedule an in-person meeting soon. Capito, in a tweet, called the conversations constructive and substantive. "It's all moving forward. It's all positive," she told reporters at the Capitol earlier in the day. And GOP Senator James Inhofe of Oklahoma said he thinks a deal on that portion of Biden's plans is within reach. And if Democrats want to then try to pass the social spending on their own, let them do that. Biden ally Senator Chris Coons of Delaware said trying to strike a deal with Republicans on some portion of Biden's plan is necessary because there are Democrats who will balk at trying to pass the rest of it on a partisan basis, as was done with the $1.9 trillion COVID relief bill earlier this year. Negotiating with Republicans is crucial both for the benefits of bipartisanship on its own and for internal and political reasons, Coons said. We don't have a path towards passing $2.3 trillion by reconciliation without trying. That was reinforced by West Virginia Democrat Senator Joe Manchin, one of the moderates whose vote would be pivotal to Biden's plans in a Senate split 50-50 between the two parties. "I just want to try to work with all my colleagues, and they've got to prove me wrong first that they're basically not willing to do anything," he said. Negotiations won't end even if Democrats go it alone on the bigger parts of Biden's plans. Eroding public support for Biden's proposals would put pressure on swing state Democrats, including Manchin and Arizona's Kirsten Sinema, to demand a dramatic downsizing. Senator Tim Scott, delivering the opening broadcast on the Biden agenda in the Republican televised rebuttal to the president's speech, said, "Our best future won't come from Washington schemes or socialist dreams. It will come from you, the American people," Scott said. McConnell on Thursday said Biden was dividing the country and warned that changes made without GOP support in Congress could easily be reversed whenever Republicans gain control of Washington. On traditionally bipartisan issues as pandemic relief, voting rights and infrastructure, Democrats are addicted to divide and conquer, he said. Whatever bipartisan Democrats get done through brute force will be fragile. Even as McConnell trained his fire on the Biden plans, Trump was appearing at the same time on Fox Business Network, calling on the party to oust McConnell as leader. a sign that internal bickering would continue to cloud the GOP's message. But the point about all of this is there is a really critical issue with regard to how you actually make an economy work. Trickle down doesn't work. Taxing the poor to pay for the rich doesn't work. And so the whole concept of turning this around and building from the middle out is very powerful, something which I think we should learn in Australia. But then Australia's top economists have overwhelmingly backed a decision by Treasurer Josh Frydenberg to reset the budget strategy so that it prioritised achieving an unemployment rate of between 4 and 5% over reducing debt. Australia hasn't had an unemployment rate below 5% since 2011. It hasn't had an employment rate below 4% since the early 1970s. The new wording of the fiscal strategy required in the budget as part of the Charter of Budget Honesty will commit the government to quickly drive down unemployment until the unemployment rate is between 4 and 5%. Only when the unemployment rate is substantially within that band will the strategy switch to a focus on reducing government debt as a share of GDP. The existing wording introduced in last year's budget in response to the COVID-19 crisis only commits the government to drive down unemployment until the rate is comfortably below 6%. Treasurer Frydenberg spelled out the new strategy in an address to the Australian Chamber of Commerce and Industry on Thursday, saying both the Treasury and the Reserve Bank now believe that the so-called non-accelerating inflation rate of unemployment was lower than 5%. In effect, both the bank and Treasury's best estimate is that the unemployment rate will now need to have a 4 in front of it, he said. The Reserve Bank was limited in its ability to cut interest rates further, meaning greater weight would have to be placed on the budget to bring unemployment down to between 4 and 5%. Of course, the exact wording of the new strategy won't be unveiled until budget night on the May the 11th. The increased ambition means the government plans to usher in an era of sustained low unemployment not seen since the prime ministerships of Robert Menzies, Harold Holt, John Gorton and William McMahon. Of the 60 leading Australian economists surveyed by the Economic Society of Australia and The Conversation ahead of the announcement, more than 60% wanted the target strengthened to an unemployment rate below 5%. Some 21%, which is 13 of the 60, wanted the target strengthened to an unemployment rate below 4%. 5 wanted the target strengthened to an unemployment rate below 3%. Only one of the 60 top economists surveyed wanted an immediate tightening of the budget regardless of the unemployment rate. Tony Makin, a former International Monetary Fund and Treasury economist who was critical of Australia's stimulus program during the global financial crisis, says the present ultra-low interest rate settings are more than enough to drive unemployment as low as it can get without stoking runaway inflation. He says the extra government debt that would be created by a push for even lower unemployment would put Australia's credit rating at risk and push up interest rates and the Australian dollar, making Australian export less competitive. The economists chosen by the Economic Society to take part in the survey are recognised leaders in fields including microeconomics, macroeconomics, economic modelling and public policy. Among them are former and current government advisors, former heads of government departments and agencies, and former members of the Reserve Bank Board. Labour market specialist Sue Richardson said Australia faced an unusual opportunity to test how low unemployment could go before a tight labour market produces unacceptable stresses. The combination of reduced temporary migration, very low inflation and inflation expectations, and the relaxation in the focus on containing the size of the government debt make this a rare moment. Consultant Nikki Hutley said if the experience of the United States before COVID was any guide, Australia might be able to get its unemployment rate down to 3.5% without stoking accelerating inflation. With interest rates at such low levels, investing in Australia's economic future could not be a better decision. Economist Saw Eslake said it wasn't unreasonable for the Treasurer to have proposed a threshold of an unemployment rate comfortably below 6% before beginning budget repair last year, given that at that time the conventional wisdom was that unemployment was headed towards 10%, but now both the Treasury and the Reserve Bank have made it clear unemployment can be forced lower without stalling inflation. 4 point something is realistic. Inflation figures released on Wednesday, of course, showed one of the most reliable measures of inflation, known as the trimmed mean, as an all-time low. Another reason for the government to delay winding back debt was that it would give the Reserve Bank an opportunity to lift interest rates sooner, giving it greater ability to cut interest rates to fight downturns in the future. And in fact, a report released by the Parliamentary Budget Office on Wednesday said reducing the government's debt to GDP ratio to pre-pandemic levels would take decades, even under relatively optimistic scenarios. In fact, they looked at 27. But it added that debt servicing costs would remain subdued as the existing debt was borrowed at historically low interest rates. Macquarie University's Geoffrey Kingston said it was the wrong time to be thinking about either an unemployment or debt target. What mattered this year more than most was the composition of government spending. That means better supplies of the vaccines, more facilities for mass vaccinations, and safer quarantine. Peripheral programs such as subsidising airfares to holiday destinations at a time when it remained imprudent to encourage air travel was much less important, even if they helped fight unemployment. But to me, the real question is this: are we still going to see a replay of Trickle Down here in Australia? Because so far, that's the way it looks. I'm hoping for something different. I'm hoping that the message from Biden and the fact that trickle down is dead permeates through into the budget in a couple of weeks. If it does, that could signal a significant change in the weather. On the other hand, if it's more same old, and if all the incentives to make jobs goes to the big end of town, and if average incomes continue to languish, and if employment is measured as the odd hour worked, then that tells me that whatever they say, they're not really serious about reforming and changing and evolving. I think we can learn a lot from Biden. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.